One single copper and gold mine buried deep in Indonesia's mountains generates enough revenue to fund entire national budgets, and in September 2025, when 800,000 tons of mud buried it, copper prices worldwide spiked 3.6% in a single day. Grasberg mine in Papua, Indonesia, has produced over 27 billion pounds of copper and 46 million ounces of gold since 1990. That's enough copper to wire 22 million homes and enough gold to mint 1.5 billion one-ounce gold coins. While you're reading this, the mine sits silent, flooded with mud, after a tragic incident that killed 7 workers and halted operations at the world's second-largest copper mine. When it was operating at full capacity, Grasberg processed 240,000 tons of ore every single day. That's 10,000 tons every hour, 167 tons every minute, nearly 3 fully loaded dump trucks every single second. This isn't just another mining operation. Grasberg contains proven and probable reserves of 30.8 billion pounds of copper and 26.3 million ounces of gold as of December 2022. At current metal prices, around $4.77 per pound for copper and $2,650 per ounce for gold. That's approximately $147 billion in copper reserves and $69.7 billion in gold reserves. We're talking about $216.7 billion worth of metal still buried in the mountain, more than the GDP of countries like Hungary or New Zealand. The mine is located in the remote highlands of the Sudirman mountain range in Papua, Indonesia, at elevations exceeding 2,500 meters. That's over 8,200 feet above sea level, making it one of the highest major mining operations on Earth. The nearest town is Timika, about 96 kilometers away, connected by a treacherous mountain road and ore pipeline. Grasberg is operated by PT Freeport Indonesia, a joint venture where the Indonesian government owns 51.23% and American company Freeport-McMoRan holds 48.77%. This ownership structure was finalized in 2018 after years of negotiations, with Indonesia asserting majority control over its natural resources. Freeport-McMoRan, despite owning less than half, manages the mining operations and consolidated PT Freeport Indonesia's results into its financial statements. For Freeport, Grasberg represents approximately 30% of its total copper output and 70% of its gold production, making this mine absolutely critical to the company's global operations. But here's what makes this story remarkable. This deposit was almost developed too slowly to matter. Before I show you exactly how much money flows through this operation annually, you need to understand how geologists in 1988 discovered reserves worth $40 billion in an area where copper had already been mined since the 1970s, and how that discovery would reshape Indonesia's economy. Let me start with the money. Then we'll circle back to the discovery story that nearly didn't happen. In 2023, Grasberg produced 680,000 tons of copper. That's 1.5 billion pounds. At an average 2023 copper price around $3.84 per pound, that's approximately $5.76 billion in copper revenue from this single mine in 1 year. But copper is only half the story. Grasberg also produced 1.7 million ounces of gold in 2023, at an average 2023 gold price around $1,940 per ounce. That's another $3.3 billion in gold revenue. Add them together, and you're looking at roughly $9 billion in combined copper and gold revenue annually from one mine. And that's not counting the 6 million ounces of silver produced as a byproduct. That's $24.7 million in revenue every single day, $1.03 million every hour, $17,123 every minute. The mine operates 24 hours a day, 365 days per year. Production literally never stops. While you sleep, while you eat, while you're reading this sentence, thousands of tons of ore are being crushed, ground, and processed into copper-gold concentrate deep inside mountains in Papua. Now, Freeport-McMoRan doesn't break out. Grasberg's profitability separately in public filings, but we can estimate the economics. In 2016, when the open pit was still operating at full capacity, Grasberg produced more than 1 billion pounds of copper and 1 million ounces of gold. In the 1990s, the mine was extracting approximately $7.2 million worth of gold, copper, and silver every single day. The refined metal harvested annually at that time was worth approximately $2 billion, and that was when metal prices were far lower than today. The September 2025 mudslide tells you everything about Grasberg's global importance. On September 8, 2025, approximately 800,000 metric tons of wet material surged through multiple levels of the underground Grasberg block cave mine. 2 workers were killed immediately, and 5 others went missing. By October 6, 2025, all 7 bodies had been recovered after weeks of desperate searching through mud and debris. Freeport-McMoRan declared force majeure, a legal term meaning they could not fulfill contracted deliveries due to circumstances beyond their control. Copper prices on the London Metal Exchange immediately jumped 3.6% to $10,336 per ton, the highest level since May 2024. Freeport's stock price plummeted 15.23% in a single day, wiping out billions in market capitalization. This wasn't just a mining accident. It was a geopolitical and economic event affecting global commodity markets. The Grasberg block cave ore body, where the incident occurred, represents 50% of PT Freeport Indonesia's proven and probable reserves, and approximately 70% of the company's forecast copper and gold production through 2029. Losing access to this ore body, even temporarily, is catastrophic for Freeport's financials. For the fourth quarter of 2025, Freeport expects copper and gold sales from Grasberg to be insignificant, down from previous estimates of 445 million pounds of copper and 345,000 ounces of gold. That's roughly $2.1 billion in lost revenue in a single quarter. For 2026, production from Grasberg could be approximately 35% lower than pre-incident estimates of 1.7 billion pounds of copper and 1.6 million ounces of gold. A return to pre-incident operating rates may not occur until 2027, meaning potentially 3 years of disrupted production. Benchmark Mineral Intelligence estimates the cumulative production loss through the end of 2026 could total 591,000 metric tons of copper. That's nearly equivalent to the annual production of Kolawesi, the world's 3rd largest copper mine. Goldman Sachs revised its 2025 copper market balance from a surplus of 105,000 tons to just 55,500 tons, swinging the entire global copper market into a tighter balance because of one mine's problems. Bank of America upgraded its copper price forecasts by 11% for 2026 and 12.5% for 2027, projecting prices could reach $11,313 per ton in 2026 and $14,500 per ton in 2027. This is the power of concentrated supply. Grasberg accounted for approximately 3 to 4% of global copper supply before the accident, and its shutdown triggered a market-moving event felt worldwide. Let's establish exactly where this copper and gold comes from. Grasberg currently operates 3 underground mines: Grasberg Block Cave, Deep Mill Level Zone, and Big Gossan. The Grasberg Block Cave is mining the same ore body that was previously extracted from the surface in the massive open pit that operated from 1990 to 2019. The open pit, at its peak, was 2.4 kilometers wide at the surface. That's nearly 1.5 miles across, a crater visible from space. In 2023, the 3 underground mines collectively milled more than 72 million tons of ore. That's 197,260 tons every single day on average. The mill and concentrating complex is one of the largest in the world, with 4 crushers and 2 giant semi-autogenous grinding units that processed a daily average of 240,000 tons of ore back in 2006, The ore undergoes primary crushing at the mine, then is delivered by ore passes to the mill complex for further crushing, grinding, and flotation. A flotation reagent separates copper-gold concentrate from waste rock. The concentrate is then pumped as slurry through a 166-kilometer pipeline down the mountain to the port at Amamapare on the coast. At Amamapare, the slurry is dewatered, dried, and loaded onto ships for transport to smelters around the world, primarily in Asia. This pipeline, built to handle enormous volumes, is an engineering marvel, pumping thousands of tons of concentrate slurry downhill through 166 kilometers of pipe every single day. According to reserves data from December 2022, Grasberg's proven and probable mineral reserves total 30.8 billion pounds of copper, 26.3 million ounces of gold, and 121.3 million ounces of silver. That's 14 million tons of copper metal, 808 tons of gold, and 3,773 tons of silver. At current prices, we're talking about $147 billion in copper, $69.7 billion in gold, and roughly $3.2 billion in silver. About $220 billion in total metal value still underground. But that's just proven and probable reserves, the ore that's economically viable to extract with current technology and prices. The Grasberg Minerals District contains additional resources that could be converted to reserves with more drilling and engineering. The Kusing Liar deposit alone, currently under development, is expected to produce over 7 billion pounds of copper and 6 million ounces of gold between 2029 and the end of 2041. At full operating rates, Kusing Liar should produce approximately 560 million pounds of copper and 520,000 ounces of gold annually. That's adding another significant production center to an already massive mining complex. The mine employs approximately 24,000 workers, including both contract and non-contract employees. A union represents about 18,000 of these workers, giving organized labor significant influence over operations. In 2011, 70% of Grasberg workers joined a strike that lasted weeks, appealing for higher pay and blocking roads, clashing with police, and cutting the concentrate pipeline in several places. Freeport halted operations in Papua amid deteriorating security and intensified calls for Papuan independence. These aren't just labor disputes. They're political events with regional implications. The indigenous Papuan population has long had complex relationships with the mine, balancing economic opportunities against environmental concerns and questions about benefit sharing. Now let's go back to 1988, because the discovery of Grasberg is a story of persistence, geological intuition, and recognizing what others missed. Freeport had been operating the Grasberg mine in Papua since the early 1970s, extracting copper from a deposit discovered by Dutch geologists in the 1930s. By the MID-1980s, the original Grasberg mine was largely depleted. Freeport explored the surrounding area for other deposits, and in 1988 they identified reserves at Grasberg, Grass Mountain in Dutch, just 3 kilometers from the exhausted Grasberg mine. The reserves were initially valued at $40 billion based on 1988 metal prices. Think about that. $40 billion in 1988 dollars is equivalent to roughly $100 billion in today's money, adjusting for inflation. To develop Grasberg, Freeport needed to build a road capable of carrying heavy mining equipment up extremely steep mountain terrain. The project was estimated to cost $12 million to $15 million. An Indonesian road builder named Ilyas Hamid, who had contributed to the original Grasberg road, took a bulldozer and drove it downhill, tracing a path, essentially designing the road by actually driving the route. The final cost? Just $2 million when completed. This type of cost control and practical problem solving made the entire Grasberg development possible. Without that road, there would be no mine. The location is simply too remote and too high to access any other way. The Grasberg open pit began shipping ore in late 1990 and officially opened production in 1991. Early operations used aerial tramways to move ore, dropping it 600 meters vertically for processing, then pumping it as slurry through the 166-kilometer pipeline to the port. As of the MID-1990S, Freeport had spent $3 billion to develop the mine and extract its minerals. The company was the largest single American investor in Indonesia, with a market capitalization of $5 billion, and the mine was the country's most profitable business, generating more than $1 million per day in profit. The 2003 to 2006 boom in copper prices dramatically increased Grasberg's profitability. Extra consumption of copper for Asian electrical infrastructure overwhelmed supply, and prices increased from around $1,500 per ton to $8,100 per ton, from 70 cents per pound to $4 per pound. At $4 per pound copper, Grasberg's production was generating extraordinary cash flow. When you're extracting 1 billion pounds of copper annually at $4 per pound, that's $4 billion in copper revenue alone before adding gold and silver. The ore grades at Grasberg are exceptional. The main Grasberg stock averages 1.5% copper and 2 grams per ton gold. That's high grade by global standards, especially for a deposit of this size. Most major copper mines worldwide operate with ore grades between 0.4% and 0.8% copper. Grasberg's 1.5% copper grade means you get nearly double the copper per ton of ore processed compared to average mines. This is critical because processing costs are largely driven by tonnage, not grade. If you're processing 240,000 tons per day at 1.5% copper versus 0.75% copper, you get twice as much metal output for similar processing costs. The geology of the deposit is fascinating. The ore bodies are located within and around two main igneous intrusions, the Grasberg monzonite and the Erzberg diorite. These formed when metal-rich magma intruded into limestone and sedimentary rocks during the uplift of the Sudirman Mountains. The collision of tectonic plates created ideal conditions for porphyry copper deposits enriched with gold. Mineralization occurred in a relatively short time frame between 2.5 and 3.5 million years ago, shortly after the emplacement of the metal-laden igneous rocks. Chalcopyrite is the dominant ore mineral, with lesser amounts of bornite, chalcocite, and covellite. Gold concentrations usually occur as microscopic inclusions within the copper sulfide minerals, though in some parts of the deposit gold is also strongly associated with pyrite. This intimate association of copper and gold makes Grasberg uniquely valuable. You're extracting two precious metals simultaneously. The transition from open pit to underground mining represents one of the largest and most complex mining projects ever undertaken. From 1990 to 2019, the Grasberg open pit produced over 27 billion pounds of copper and 46 million ounces of gold over a 30-year period. That's an average of 900 million pounds of copper and 1.5 million ounces of gold per year from the open pit alone. The pit grew to 2.4 kilometers wide and several hundred meters deep before mining shifted underground. Underground mining began with the Deep Ore Zone in 1989, which operated until depletion at the end of 2021. The Deep Mill Level Zone started ramping up production as DAWs depleted, mining ore at the 2,590-meter elevation level. The Grasberg Block Cave, which began ore extraction in the first half of 2019, uses block caving, a mass underground mining method where large blocks of ore are systematically undercut, causing the ore to fracture and cave under its own weight. As ore is extracted from below, more ore above caves and becomes available for extraction. Block caving is one of the most cost-effective underground mining methods for large, massive ore bodies, but it requires extensive infrastructure and careful geotechnical management. The development work for the Grasberg Block Cave alone included 30,000 meters of ventilation and conveyor declines. Ore is transported to the processing facility by a fully autonomous underground railway system, driverless electric trains running on schedule through kilometers of underground tunnels. This automation improves safety by removing workers from haulage operations and increases efficiency through optimized scheduling. In 2023, milling rates from the three underground mines averaged approximately 206,600 metric tons of ore per day. That's an increase from 188,700 metric tons per day in the third quarter of 2022, demonstrating steady ramp-up toward full production capacity. But achieving and maintaining this production level requires constant investment. Freeport announced in 2023 that it was completing installation of additional milling facilities to increase capacity to approximately 240,000 metric tons of ore per day. A mill recovery project was also underway, installing a new copper cleaner circuit expected to provide incremental production of approximately 60 million pounds of copper and 40,000 ounces of gold per year. Every efficiency improvement translates directly to millions of dollars in additional revenue. Let's talk about the economic impact on Indonesia, because Grasberg isn't just important to Freeport. It's fundamental to Papua's economy and significant to Indonesia's national finances. At full operation, Grasberg accounts for substantial export earnings that contribute meaningfully to Indonesia's GDP. The mine has historically contributed multiple percentage points to Indonesia's GDP through direct production value, tax payments, employment, and induced economic activity. In 1995, the Overseas Private Investment Corporation noted that 60,000 people were linked to the mine, employees and their families, living in a company compound carved from the jungle. The company town, Tembagapur, or Copper Town, features air-conditioned markets with American goods, modern apartments, schools, hospitals, and recreation facilities. Freeport built an airport, a port at Amamapare, 119 kilometers of access roads, and supporting infrastructure to enable operations in this remote location. For Papua province specifically, Grasberg represents an even larger share of economic activity. The mine is one of the few major industrial operations in the region, providing high-wage jobs that are otherwise scarce in this remote, underdeveloped province. Mining jobs at Grasberg pay significantly above Indonesian national averages. These high wages create local purchasing power and support a network of suppliers, contractors, and service providers throughout the region. But this economic importance creates tension. Indigenous Papuan communities have raised concerns about environmental damage, displacement, and inequitable benefit sharing. The low share of revenue going directly to local Papuans has been a persistent source of friction. The Indonesian government, headquartered in Jakarta, thousands of kilometers away, collects tax revenue from the mine, but local communities feel they bear the environmental and social costs without receiving proportional benefits. Geopolitically, the 2018 ownership restructuring was significant. Indonesia essentially nationalized majority control of its largest copper-gold mine, asserting resource sovereignty while allowing Freeport to continue managing operations. This pattern reflects broader trends in resource-rich developing nations. Initial development by foreign mining companies with technical expertise and capital, followed by eventual government assertion of ownership as mines mature and generate substantial cash flow. Indonesia negotiated from a position of strength. Freeport had already invested billions developing the mine and couldn't simply walk away. The extension of Freeport's operating rights from 2021 to 2041, secured as part of the ownership restructuring, provides long-term stability. With potential extension beyond 2041, the mine could operate for decades more, depending on copper prices, technology, and reserve expansion. Indonesia has also enacted regulations requiring domestic processing of copper concentrates. Freeport agreed to expand domestic smelting and refining capacity to process all of its copper concentrates within Indonesia. Construction of the Majeure smelter in Grasberg, with a capacity of 1.7 million metric tons of copper concentrate annually, was expected to be completed in 2024. This $3.85 billion facility would process the bulk of Grasberg's concentrate production, adding value within Indonesia rather than exporting raw concentrate. However, the September 2025 mudslide casts doubt on the smelter ramp-up timeline. If Grasberg produces significantly less concentrate through 2026 and into 2027, the new smelter will lack sufficient feedstock to operate at designed capacity. This creates a cascade effect. Disrupted mine production affects smelter commissioning, which affects employment at the smelter, which affects Indonesia's downstream processing ambitions, which affects government revenue projections. One mudslide at one mine ripples through an entire industrial ecosystem. The environmental challenges at Grasberg have been controversial for decades. The mine generates tailings, finely ground waste rock, at a rate of approximately 700,000 tons per day. These tailings wash into the Iqua River system and eventually reach the Arafura Sea. Some 130 square kilometers of lowland areas along the Iqua River are now covered by braided sedimentary channels, indicative of high sediment load. Most native fish have disappeared from the now turbid waters of the Iqua River, which are unsuitable for aquatic life due to sediment, dissolved copper, and altered water chemistry. The overburden, waste rock that doesn't go through the mill, remains in the highlands up to 480 meters deep, covering 8 square kilometers. The acidic runoff from this waste rock, containing dissolved copper and fine material, washes into the headwaters of the Watagan River. Environmental groups and local citizens have expressed concerns about copper contamination and acid mine drainage from mine tailings into surrounding river systems, land surfaces, and groundwater. In 1995, the Overseas Private Investment Corporation revoked Freeport's environmental insurance policy for violations that would not be allowed in the United States. This was the first action of this sort by OPIC. Freeport responded with a lawsuit, arguing that an environmental report reached inaccurate conclusions based on a single visit to Grasberg in 1994. The company later underwent an independent environmental audit by Dames and Moore and received what they characterized as a clean bill of health. In April 1996, Freeport canceled its OPIC policy, stating that their corporate activities had outgrown the policy's limits. The OPIC report was publicly released, and environmental scrutiny has continued ever since. Freeport insists its practices meet industry standards for riverine tailings disposal. However, that's not a position held by many environmental groups and local citizens, who argue that industry standards are insufficient to protect fragile ecosystems. The company has begun landscape reclamation projects at the mine, but the scale of disturbance is enormous. When you're processing 240,000 tons of ore per day and generating 700,000 tons of tailings daily, the environmental footprint is unavoidable. Freeport has faced multiple safety incidents beyond the 2025 mudslide. In 2003, a landslide killed 8 workers after warning signs were detected 2 days prior. Management moved some equipment but did not evacuate workers from the area. A government investigation concluded the incident resulted from negligence, though this conclusion was later overturned, and the incident attributed to natural causes. A month after the 2003 landslide, 2 workers died from exposure to sulfur fumes. In 2013, a roof collapse in the Big Gossan mine underground training center trapped 38 workers, only 10 survived. The miners were trapped inside a lower chamber while attending a refresher training course on work safety. The absence of a secondary escape route was critical to the loss of life. According to Freeport's geological team, the collapse was caused by erosion of the ceiling, brought about by continuous infiltration of limestone wall rocks by corrosive acidic groundwater. Freeport was accused of negligence by the Indonesian National Human Rights Commission. These incidents demonstrate the inherent dangers of underground mining, particularly in challenging geological conditions, with acidic groundwater, complex rock mechanics, and massive underground excavations. The September 2025 mudslide, involving 800,000 tons of wet material, was described by Freeport as unprecedented in PT Freeport Indonesia's multi-decade history of block cave mining operations. Freeport has property and business interruption insurance policies covering up to $1 billion in losses related to the 2025 incident, with a $700 million limit on underground incidents, subject to a $500 million deductible. That means Freeport must absorb the first $500 million in losses before insurance coverage begins. For a company with Grasberg representing 30% of copper production and 70% of gold production, a prolonged shutdown is financially devastating regardless of insurance. The lost production cannot be fully recovered. Each day the mine sits idle is revenue that disappears forever. Looking at the broader copper market context, Grasberg's disruption comes at a terrible time for global supply. Copper demand is accelerating due to electrification, electric vehicles, renewable energy infrastructure, and AI data centers. Meanwhile, major copper mines worldwide are experiencing grade declines, operational challenges, and political disruptions. Chile's El Teniente mine suffered a tunnel collapse in July 2025 that killed 5 workers and forced a week-long shutdown. Ivanhoe's Kamoa-Kakula mine in the Democratic Republic of Congo experienced flooding. Hudbay Minerals suspended operations at its Constancia mill in Peru due to political protests. The cumulative effect of these disruptions is a tightening global copper market, and exactly the moment when demand is surging. Analysts are revising disruption allowances higher because dependence on a small group of megamines creates systemic vulnerability. The top 20 copper mines supply approximately 36% of global copper output. When one of those top mines goes offline unexpectedly, the impact reverberates globally. Grasberg ranked as the world's second largest copper mine before the September 2025 incident. Only Chile's Escondida mine produces more copper annually. Grasberg's combination of copper and gold production makes it even more strategically important. While many copper mines produce some gold as a byproduct, Grasberg's gold output is substantial enough that it ranks among the world's largest gold mines as well. In 2016, the mine produced more than 1 billion pounds of copper and 1 million ounces of gold. That level of production places it in the top tier globally for both metals simultaneously. Future outlook depends critically on successfully restarting operations and ramping back to full capacity. Freeport expects the unaffected Big Gossan and Deep Mill Level Zone mines could restart operations by mid-fourth quarter 2025. A phased restart and ramp-up of the Grasberg Block Cave mine is projected to begin in the first half of 2026, initially in 3 production blocks. The remaining production blocks would resume operations in 2027. This timeline assumes successful completion of repairs to mobile equipment, rail infrastructure, ore chutes, electrical systems, communication systems, and supporting infrastructure damaged by the mudslide. It also assumes the investigation identifies the cause and implements corrective measures that prevent recurrence. If all goes according to plan, Grasberg could return to pre-incident operating rates by 2027. That would mean only 2 years of severely disrupted production instead of a permanent impairment. But if all goes according to plan is a big assumption after 800,000 tons of mud flooded underground workings in an unprecedented incident. Block caving inherently involves managing enormous underground voids and fractured rock masses. It's always geotechnically challenging. The investigation, expected to be completed by year-end 2025, will determine root causes and recommend safeguards. Indonesian government authorities are closely monitoring the investigation and search operations. Political pressure on Freeport is intense. 7 workers are dead, operations are suspended, Indonesia's new smelter lacks feedstock, tax revenue has evaporated, and global markets are disrupted. If the investigation reveals negligence or inadequate safety procedures, Freeport could face regulatory consequences, fines, or operational restrictions that extend beyond simple repairs. The Indonesian government, as majority owner, has both incentive to restart operations quickly and obligation to ensure safety. Freeport's stock price decline of 15% in a single day after declaring force majeure reflects investor concern about prolonged disruption and potential liability. The company's market capitalization dropped by billions of dollars as traders priced in years of reduced production from their most valuable asset. For context, Freeport-McMoRan's total enterprise value before the incident was approximately $60 billion, to $70 billion. Losing 15% of market cap in one day represents roughly $9 billion to $10 billion in shareholder value destroyed. The production history of Grasberg reveals remarkable consistency despite challenges. In 1999, production totaled 827,000 tons of copper, 150,000 ounces of gold, and 3.53 million ounces of silver from the open pit operation. That copper production alone, at 1999 prices around 75 cents per pound, represented approximately $1.24 billion in revenue. Add the gold at roughly $290 per ounce in 1999, and you get another $43.5 million, about $1.28 billion combined. By 2013, production was projected to reach 1.1 billion pounds of copper and 1.2 million ounces of gold, a 54% increase in copper and 31% increase in gold over 2012 figures as underground operations ramped up. In 2016, the mine produced more than 1 billion pounds of copper and 1 million ounces of gold. At 2016, average prices around $2.21 per pound for copper and $1,251 per ounce for gold. That represented approximately $2.2 billion in copper revenue and $1.25 billion in gold revenue, roughly $3.45 billion total. The mine was minting money faster than many central banks. The 2023 production of 680,000 tons copper and 1.7 million ounces gold represents a shift in the production profile as operations transitioned fully underground. Underground mining, while more expensive per ton than open pit, accesses ore that cannot be reached from the surface. The ore grades in underground mining are typically higher than the declining grades at the bottom of open pits, which can offset the higher operating costs. Grasberg's underground ore grades of 1.5% copper and 2 grams per ton gold are excellent by any standard. Compare that to global copper operations averaging 0.5% to 0.7% copper, and you understand why Grasberg remains economically viable despite the challenges of underground mining at 8,200 feet elevation in remote Indonesian mountains. High grades compensate for high costs. The processing capacity expansion over time demonstrates aggressive scaling. The mine started with a Los Colorados-style concentrator, processing 35,000 tons per day when the open pit began in 1990. By 2006, the mill and concentrating complex was processing 240,000 tons per day, nearly 7 times the original capacity. This expansion required billions in capital investment: crushers, grinding mills, flotation circuits, thickeners, pumping stations, and supporting infrastructure. The 3 concentrators currently operating, handling different ore types and maintaining operational redundancy, represent technological sophistication beyond what most people imagine when they think of a mine. This is industrial-scale mineral processing, as complex as a modern refinery. The flotation process uses carefully controlled chemical reagents to selectively separate copper and gold minerals from waste rock. Crushed ore is ground to fine powder, mixed with water and chemicals, then agitated in enormous flotation cells. Air bubbles are introduced, and hydrophobic copper sulfide particles attach to the bubbles and float to the surface as froth. Hydrophilic waste rock particles sink to the bottom as tailings. The copper-rich froth is skimmed off, filtered and dried to create concentrate grading 25% to 30% copper, a massive enrichment from the original 1.5% copper in the ore. This concentrate, containing valuable gold and silver alongside the copper, is the product that gets pumped down the mountain. The 166-kilometer pipeline from Grasberg to Amamapar is itself an engineering achievement. Pumping slurry, a mixture of finely ground concentrate and water, through 166 kilometers requires careful management of particle size, water content, flow velocity, and pressure. If the slurry is too thick, it won't flow. If it's too thin, you're pumping mostly water, which is inefficient. The pipeline must maintain continuous flow because stopping allows solids to settle and potentially clog the line. Restarting a clogged 166-kilometer pipeline would be a nightmare. At Majeure, the dewatering process uses filtration and drying to produce shippable concentrate with approximately 8 to 9% moisture content. Too much moisture adds dead weight to shipments and can cause chemical reactions during ocean transport. The dried concentrate is stored in covered facilities before being loaded onto bulk carrier ships, bound primarily for Asian smelters. China, Japan, and India are major destinations for Grasberg's concentrate. Smelters purchase the concentrate, paying for contained copper, gold, and silver, minus treatment and refining charges. When concentrate markets are tight, as they are now with Grasberg offline, treatment charges decline because smelters compete for limited feed. When concentrate markets are oversupplied, treatment charges rise because miners compete to place their production. This dynamic affects the net realized price Freeport receives for its metal production. The ownership restructuring from 2017 to 2018 was complex and contentious. Freeport originally held a 90.64% stake in PT Freeport Indonesia, with Rio Tinto holding a 40% participating interest in production. Indonesia's 2009 mining law required foreign mining companies to divest majority ownership to Indonesian entities and transition from contracts of work to special mining licenses. The government set a deadline requiring Freeport to comply or face potential loss of operating rights. Negotiations dragged on for years. Freeport argued that forcing divestment violated the sanctity of their original contract of work, signed decades earlier. Indonesia countered that resource sovereignty, and the 2009 mining law took precedence. The Indonesian government held enormous leverage. Freeport had billions invested in Grasberg and couldn't simply walk away. The final deal, announced in 2018, saw Freeport divest 51.23% ownership to Indonesian entities, primarily PT Inalum, the state-owned aluminum company, later reorganized as PT Mineral Industri Indonesia, or MIND ID. Freeport retained 48.77% and continued as operator managing day-to-day mining activities. In exchange, Indonesia granted Freeport a special mining license extending operating rights through 2031, with provisions to extend to 2041, subject to meeting various conditions. The $3.85 billion transaction valued PT Freeport Indonesia at roughly $7.5 billion. This ownership transfer deprived Freeport-McMoRan of the title of world's largest copper mining company, a distinction that reverted to Chile's state-owned Codelco. For Freeport, maintaining operating control despite minority ownership was crucial. They have the technical expertise to manage this complex operation. For Indonesia, achieving majority ownership satisfied nationalistic sentiments and ensured greater resource benefit capture. The arrangement represents a pragmatic compromise. Indonesia owns the majority. Freeport operates and manages. Both parties benefit from continued production. The path forward for Grasberg involves balancing speed of restart against thorough investigation and safety improvements. Rush back too quickly without addressing root causes, and you risk another incident. Take too long with excessive caution, and you extend production losses unnecessarily. Indonesia needs the tax revenue, Freeport needs the production, workers need the employment, and global markets need the copper and gold. The financial impact on Freeport-McMoRan's overall business is severe. In the third quarter of 2024, before the September 2025 mudslide, Freeport reported free cash flow of $673 million, a significant increase from $58 million in the third quarter of 2023. For the first 9 months of 2024, Freeport generated total free cash flow of $2,155 million. Losing Grasberg's production threatens this cash generation capability since the mine represents such a large portion of the company's copper and gold output. Freeport's total copper production for the fiscal year ending June 2024 was approximately 1.8 million tons. Grasberg's contribution of roughly 680,000 tons in 2023 represents about 38% of Freeport's total copper when annualized. Losing that production, even temporarily, dramatically affects Freeport's ability to meet customer commitments, generate cash flow, service debt, pay dividends, and fund other operations. The force majeure declaration was legally necessary, but financially devastating. Freeport's quarterly dividend of 7 cents per share, maintained despite the Grasberg disruption, represents a commitment to shareholders, but also a cash drain when production is impaired. With roughly 1.4 billion shares outstanding, that's $105 million in quarterly dividend payments. Can Freeport sustain that dividend if Grasberg remains offline longer than expected? Probably, given diversified operations in North America and South America, including the Morenci Minerals District in Arizona and Cerro Verde in Peru. But investor confidence depends on transparent guidance about Grasberg's restart timeline. Any additional delays beyond current projections would likely trigger another stock price decline. The insurance coverage of $1 billion with a $500 million deductible helps, but doesn't fully compensate for lost production. Insurance covers physical damage and business interruption, but doesn't replace the lost opportunity to produce during high copper prices. When copper is trading at $4.77 per pound and you can't produce, you're missing a price environment that might not persist once production resumes. Commodity price cycles are cruel that way. Often the best prices occur during tight supply, and by the time disrupted mines restart, prices have moderated. The September 2025 mudslide occurred when copper prices were already elevated due to supply tightness. If Grasberg doesn't restart until 2027 as projected, will copper still be at $4.77 per pound or higher? Maybe if structural supply deficits persist. Maybe not. If global recession reduces demand or new mines come online. This price uncertainty adds financial risk to the physical and operational risks of restarting underground operations. The investigation into the mudslide's cause is critical, not just for safety, but for understanding whether similar incidents could occur in other production blocks. If the root cause is specific to PB1C production blocks, geology or mining conditions, repairs and modifications might prevent recurrence. If the root cause is a systematic issue affecting block cave operations generally, the implications are more serious. Block caving inherently involves managing massive underground voids where millions of tons of rock have been removed. The overlying rock mass fractures and caves under its own weight, which is the intended outcome. But controlling that caving process requires careful geotechnical management. Ground stress, water infiltration, rock strength, joint patterns, and mining sequence all affect cave behavior. Unexpected ground conditions or deviations from planned mining sequences can trigger uncontrolled failures. The 800,000 tons of wet material that surged through the Grasberg block cave suggests a large-scale failure of fractured rock that had accumulated water. Whether this was a natural accumulation of groundwater or surface water infiltration is part of what investigators must determine. Papua receives substantial rainfall despite its general classification as tropical highland. Water management in underground mines is always challenging. Pumping systems must remove groundwater continuously to keep workings dry. If water accumulates in fractured zones above active mining areas, it adds weight and reduces rock strength, potentially triggering failures. The wet material in the mudslide suggests water played a significant role. Implementing improved drainage, monitoring, and ground support systems based on investigation findings will be necessary before resuming production. These improvements take time and money, but are non-negotiable for worker safety and operational sustainability. The comparative analysis with other major copper-gold mines reveals Grasberg's unique position. Escondida in Chile produces more copper, approximately 1.05 million tons in 2023, but produces relatively little gold as a byproduct. Grasberg's 1.7 million ounces of gold in 2023 is substantial gold production by any measure. Only dedicated gold mines like Nevada's Carlin Trend operations or South Africa's deep-level gold mines produce comparable or greater gold volumes. The combination of being the world's second-largest copper mine and one of the largest gold mines simultaneously makes Grasberg uniquely valuable. You're essentially getting two world-class mines in one location. Oyu Tolgoi in Mongolia, another massive copper gold mine, offers an interesting comparison. Oyu Tolgoi has enormous reserves but faced years of development delays, cost overruns exceeding $10 billion, and political conflicts with the Mongolian government over benefit sharing. Grasberg faced similar political challenges but resolved them through the 2018 ownership restructuring. Both mines demonstrate the pattern. Rich developing nations with world-class deposits eventually assert ownership while allowing foreign companies with technical expertise to continue operations. The geopolitical dimension of copper supply extends beyond individual mines. China's dominance in copper smelting and refining, processing roughly 50% of global mine production, creates strategic dependencies. Western mines like Grasberg and Escondida produce concentrate that gets shipped to Chinese smelters, refined into copper metal, then often manufactured into products that get exported back to Western markets. This circuitous supply chain creates vulnerabilities during trade tensions. The United States has limited domestic smelting capacity, making it dependent on imports of refined copper metal or shipments of concentrate to Asian smelters. Indonesia's push to build domestic smelting capacity through the Majeure facility reflects similar concerns about capturing more value and reducing dependence on China. But building smelting capacity is expensive and requires reliable concentrate supply. With Grasberg disrupted, Indonesia's ability to operate its new smelter at designed capacity is compromised. This highlights the interconnected nature of global metal supply chains. Mine production feeds smelters. Smelters feed manufacturers. Manufacturers feed final consumers. Disruptions anywhere in the chain create bottlenecks elsewhere. The technology adoption at Grasberg represents leading-edge mining practice. The fully autonomous underground railway system transporting ore from extraction points to the mill eliminates one of the most dangerous jobs in underground mining, haul truck driving through confined spaces. Automation improves safety by removing workers from hazardous areas. It also increases efficiency through optimized scheduling, consistent operating speeds, and 24/7 operation without shift changes affecting productivity. The hydraulic fracturing operations used at the deep mill level zone demonstrate advanced geotechnical management. Hydraulic fracturing, yes, the same basic technology as in oil and gas, is used to precondition the rock mass before caving. This controlled fracturing helps manage rock stress and prevent uncontrolled seismic events that could damage infrastructure or endanger workers. Following mining-induced seismic activity experienced periodically, these hydraulic fracturing operations have been effective according to Freeport. The massive semi-autogenous grinding mills at Grasberg are technological marvels. Each SAG mill is essentially a giant rotating drum partially filled with steel balls and ore. As the drum rotates, the combination of steel balls and ore particles, grinding against each other, crushes the ore to fine powder. The largest SAG mills in the world can process tens of thousands of tons per day each. Grasberg's two SAG mills, combined with conventional ball mills and flotation circuits, create a processing system capable of handling the 240,000 tons per day throughput. This requires enormous electrical power, hundreds of megawatts continuously. The transition from coal-fired power to liquefied natural gas represents a significant sustainability initiative. Coal combustion produces high CO2 emissions per unit of energy generated. Switching to natural gas reduces CO2 emissions by approximately 50% per unit of energy, while also reducing local air pollutants like sulfur dioxide and particulate matter. The $1 billion investment in the new gas-fired combined cycle power plant demonstrates commitment to reducing environmental footprint. Combined cycle plants are more efficient than simple gas turbines because they capture waste heat from the primary turbine to generate additional electricity through a steam cycle. This efficiency improvement reduces fuel consumption and emissions per megawatt hour generated. The targeted 2027 start date for the new power plant aligns with the expected return to full production following the 2025 mudslide. If Grasberg isn't producing at full capacity, power demand is lower, which might delay the power plant commissioning. Water management at Grasberg is complex, despite the location receiving substantial rainfall. Groundwater infiltration into underground workings must be continuously pumped to maintain dry conditions. Meanwhile, the processing plant requires water for ore grinding, flotation, and concentrate transport through the pipeline. Balancing water supply and drainage while managing runoff water quality requires sophisticated engineering. The acidic runoff from waste rock and tailings represents an ongoing environmental challenge. When sulfide minerals like pyrite are exposed to air and water, they oxidize and produce sulfuric acid. This acid mine drainage dissolves metals from surrounding rock, creating contaminated water that requires treatment before discharge. Freeport has implemented water treatment systems, but the scale of operations means managing hundreds of thousands of tons of water daily. Long-term reclamation planning for Grasberg involves enormous challenges. When mining eventually ceases, whether in 2041 or later with extensions, the site will contain massive underground voids, hundreds of millions of tons of waste rock, and tailings covering vast areas. Stabilizing these features, preventing acid mine drainage in perpetuity, and restoring land functionality will require monitoring and maintenance for generations. Financial provision for closure and reclamation is part of mining regulations, but the actual costs often exceed estimates. Indonesia requires financial assurance from mining companies to cover closure costs. As the majority owner, Indonesia ultimately bears much of the financial risk if Freeport cannot fulfill closure obligations. This creates aligned incentives. Both the government and Freeport want the mine to remain profitable enough to fund closure costs when that time comes. A financially struggling mine approaching closure is the worst scenario. No profits, yet massive closure obligations remaining. The worker safety culture at Grasberg has evolved through tragedy. Each fatal incident, 2003 landslide, 2003 sulfur fumes, 2013 roof collapse, 2025 mudslide, should drive improvements in procedures, monitoring, training, and equipment. Whether these improvements are adequate is judged by future performance. Safety in underground mining is never guaranteed. The environment is inherently dangerous with heavy equipment, ground instability, confined spaces, and ever-present risks. But world-class mining operations achieve very low injury and fatality rates through systematic risk management. Grasberg's safety record, while improved over time, still includes major incidents that suggest room for further improvement. The union representing 18,000 workers has significant power to influence safety practices through collective bargaining. Worker safety demands are legitimate and should be prioritized alongside production and cost considerations. The 2011 strike that shut down operations for weeks demonstrated this power. Workers demanded higher pay, but they also raised safety concerns and benefit issues that had been neglected. Freeport's relationship with the workforce must balance cost control against worker welfare. Underpaying or disregarding safety creates discontent that eventually manifests in strikes, slowdowns, or regulatory scrutiny. The cultural and political complexity of operating in Papua adds layers of difficulty beyond typical mining challenges. Papua has experienced separatist movements seeking independence from Indonesia since the territory was incorporated in the 1960s. Indigenous Papuans view themselves as culturally and ethnically distinct from Indonesians. The mine, developed with Indonesian government permission on traditional Papuan lands, becomes entangled in these political tensions. Freeport has been accused of making payments to Indonesian security forces protecting the mine, raising human rights concerns. The company has denied wrongdoing, but acknowledged that security arrangements in a conflict zone create complex ethical situations. Environmental activists and indigenous rights advocates have protested Grasberg for decades, calling for mine closure or demanding far greater benefit sharing with local communities. These protests occasionally turn violent, leading to confrontations between protesters and security forces. Balancing legitimate security needs against human rights concerns while respecting indigenous land claims creates challenges beyond what mines in stable jurisdictions face. But withdrawing from Papua is not a realistic option for Freeport. Too much invested, too valuable a resource. Instead, the approach has been incremental improvement, better environmental practices, greater community investment, more local employment, and navigating the political transfer of majority ownership to Indonesia. Whether these measures are sufficient is debated. The future demand drivers for copper make Grasberg increasingly strategic. Global copper demand in 2024 is approximately 25 to 26 million tons annually. Projections suggest demand could reach 35 to 40 million tons by 2035 and possibly 50 million tons by 2050, driven by electrification, renewable energy, electric vehicles, and grid infrastructure. That's mere doubling of demand over 25 years. Yet, global mine supply struggles to grow. Major copper mines are aging, grades are declining, new discoveries are rare, and development timelines stretch 10 to 15 years from discovery to production. The HP estimates that $250 billion in investment is needed globally to develop enough copper mines to prevent supply deficits by 2035. That's $250 billion in capital that must be deployed over the next decade. The result is a structural supply deficit that will persist unless copper prices rise high enough to incentivize massive new investment. Current prices around $4.77 per pound are elevated, but may not be high enough to justify the highest cost new projects. Prices might need to reach $5.50 to $6.50 per pound or higher to make economically marginal projects attractive. At those price levels, Grasberg's profitability would be extraordinary. High-grade production at costs well below market prices. This is why the mine remains so valuable, and why Indonesia insisted on majority ownership. A perpetually tight copper market means Grasberg's cash flow generation capacity could increase significantly over coming decades. For gold, the dynamics differ. Gold demand is driven by jewelry, investment, and central bank reserves rather than industrial consumption. Gold prices are more volatile and less correlated with economic growth than copper. Yet Grasberg's 1.7 million ounces of annual gold production has substantial value, roughly $4.5 billion at recent prices, around $2,650 per ounce. The combination of copper and gold diversifies price exposure. When copper demand weakens in economic downturns, gold often rises as investors seek safe haven assets. This negative correlation provides some natural hedge, stabilizing revenue across economic cycles. Few mines offer this combination at Grasberg scale. The silver production of 6 million ounces annually adds further value. At recent silver prices around $32 per ounce, that's approximately $192 million in annual silver revenue. While small compared to copper and gold, every additional revenue stream improves overall project economics. The byproduct credits from gold and silver effectively reduce copper production costs. Looking at the reserve replacement and mine life extension, Grasberg's longevity depends on converting resources to reserves and making new discoveries within the minerals district. The identified resource base beyond current reserves suggests potential for mine life extension beyond 2041. The Kusing Liar deposit, with 7 billion pounds of copper and 6 million ounces of gold, adds approximately 10 years of production at planned rates. If additional ore bodies are discovered through ongoing exploration, mine life could extend further. Freeport maintains exploration rights over 167,000 hectares, about 413,000 acres, surrounding the active mining area. Systematic drilling and geologic mapping continue searching for extensions of known ore bodies and entirely new deposits. The geologic setting, porphyry copper mineralization in intrusive rocks and skarns in limestone, suggests additional deposits likely exist nearby. The challenge is finding them under thick vegetation and overburden at high elevation in remote mountains. Each new discovery adds billions in value and years to mine life. The return on investment for exploration is extraordinary when successful. Spending millions on drilling to discover billions in metal is a favorable trade. The technological innovations required to mine at Grasberg's elevation and remoteness push industry boundaries. Operating heavy equipment at 8,200 feet elevation, where air is thinner, reduces engine power, and makes physical labor more exhausting. Workers and equipment must be transported 170 kilometers up treacherous mountain roads or flown by helicopter to site. Supplying the mine with food, fuel, spare parts, and consumables requires sophisticated logistics. Everything costs more at this elevation and remoteness. Diesel fuel, explosives, grinding media, maintenance parts, fresh vegetables, all must be transported up the mountain or flown in. These higher operating costs are offset by high ore grades and economies of scale from massive throughput. But the economic margin between profitability and marginal viability is affected by factors beyond metal prices. Infrastructure costs, logistics, politics, and environmental compliance all matter. The mine's importance to Freeport-McMoRan's corporate strategy cannot be overstated, with Grasberg representing 30% of copper production and 70% of gold production. This single asset drives significant shareholder value. Freeport's stock price closely tracks copper prices because the company is fundamentally a leveraged bet on copper markets. When copper prices rise, Freeport's profits surge disproportionately due to operating leverage. Operating leverage means fixed costs are spread across production, so incremental revenue from higher prices flows largely to profits rather than being consumed by costs. A 20% increase in copper prices might translate to a 40% or 50% increase in profits for a producer like Freeport. This leverage works both ways. Falling copper prices compress profits rapidly. The September 2025 Mudslide, by removing Grasberg's production, eliminates this operating leverage on that portion of output. Fixed costs continue: debt service, corporate overhead, care and maintenance of idled facilities, while revenue vanishes. This is the worst financial outcome: costs without revenues. Restarting operations by 2027 limits the financial damage but doesn't eliminate it. 2 years of sharply reduced production from your most valuable asset permanently impairs financial performance during that period. For Indonesia, Grasberg's strategic importance extends beyond tax revenue and GDP contributions. The mine represents capability, demonstrating that Indonesia can host and eventually control world-class resource projects. Achieving majority ownership positions Indonesia as a serious player in global mining, not just a resource base for foreign exploitation. This nationalist achievement matters politically, even if operational management remains with Freeport. The construction of the Majeure smelter advances Indonesia's downstream processing ambitions. Rather than exporting raw concentrate and importing refined copper metal, Indonesia wants to capture smelting and refining value added. Every ton of copper concentrate exported represents jobs and value creation that occur elsewhere. Processing domestically creates employment, builds technical capacity, and increases government revenues through taxation of smelting operations. Similar resource nationalism has occurred in Chile with Codelco, in Mongolia with Oyu Tolgoi, in Zambia and DRC with copper mines, and elsewhere globally. Resource-rich developing nations increasingly assert ownership and processing requirements. From mining companies' perspectives, this nationalism creates challenges: ownership dilution, processing mandates, shifting regulations, and political risk. But the alternative of being expelled entirely is worse, so accommodating nationalism becomes necessary. The lesson from Grasberg: start with operational partnerships that build trust and demonstrate value. Transition gradually to majority local ownership, while retaining management control and technical expertise. Invest in local infrastructure and employment, and maintain world-class safety and environmental standards to preserve social license. This formula isn't perfect. Tensions remain, incidents occur, protests continue. But it has allowed Grasberg to operate for over 30 years and secure extensions through 2041 and potentially beyond. The Kuching Liar deposit, currently under development since October 2021, offers future production growth once operational. Expected to produce over 7 billion pounds of copper and 6 million ounces of gold between 2029 and 2041, Kusing Liar would replace declining production from older ore bodies. At full operating rates around 2030, Kusing Liar should contribute approximately 560 million pounds of copper and 520,000 ounces of gold annually. That's equivalent to adding a new world-class copper-gold mine to the Grasberg complex. But development activities are expected to continue over an approximate 10-year timeframe. That means continued capital investment of billions of dollars to access ore at the 2,605-meter elevation level beneath the southern portion of the old Grasberg open pit. If copper and gold prices remain elevated due to tight markets, these investments make strong economic sense. If prices collapse due to global recession or dramatic supply increases, economics become more challenging. The extension of Freeport's operating rights beyond 2041 would further extend the mine life and improve the return on investment for Kusing Liar development. Freeport Chairman Richard Adkerson has been in discussions with the Indonesian government about securing this extension. From Indonesia's perspective, extending the contract provides continued economic benefits from a proven productive asset. From Freeport's perspective, contract extensions provide security for multi-billion-dollar investment decisions. Grasberg has also pursued sustainability initiatives, including transition from coal-fired power to liquefied natural gas. Freeport is planning investments in a new gas-fired combined cycle facility at Grasberg, with a targeted start date in 2027 and a cost approaching $1 billion. This investment would meaningfully reduce Scope 1 greenhouse gas emissions at the Grasberg Minerals District. As climate regulations tighten globally and carbon taxes become more common, lower carbon copper commands premium prices from environmentally conscious buyers. The mine received the Copper Mark certification in November 2021 after undergoing independent assurance processes. This certification provides assurance to buyers that copper is produced according to responsible production practices. In summary, Grasberg represents one of the most significant copper-gold mining complexes in the world. The proven and probable reserves of 30.8 billion pounds of copper and 26.3 million ounces of gold, valued at over $216 billion at current prices, make it strategically irreplaceable. The cumulative production since 1990, over 27 billion pounds of copper and 46 million ounces of gold from the open pit alone, demonstrates sustained productivity over decades. Adding production from underground operations, Grasberg has likely produced over 30 billion pounds of copper and 50 million ounces of gold cumulatively. That's enough copper to wire every home in North America and enough gold to back a substantial percentage of global gold reserves. The metal from Grasberg is embedded in infrastructure worldwide, in electrical grids, buildings, vehicles, electronics, jewelry, and financial reserves. The September 2025 mudslide that killed 7 workers and halted production reveals the fragility of global copper supply chains. When a single mine accounting for 3 to 4% of global supply goes offline, markets move immediately. Copper prices spiked to 15-month highs. Freeport's stock plummeted. Analysts revised global supply forecasts, and the ripple effects extended to downstream industries dependent on copper. The incident highlights how concentrated and vulnerable the global copper supply chain has become. As the world electrifies, building out renewable energy, electric vehicles, data centers, and modern infrastructure, copper demand is accelerating. Yet the supply base is precarious, dependent on a handful of aging megamines in geologically and politically challenging locations. Grasberg sits at 8,200 feet elevation in remote Indonesian mountains, accessed by treacherous roads, processing 240,000 tons of ore daily through underground block caves, prone to geotechnical challenges, discharging 700,000 tons of tailings into river systems, operating in a region with complex political dynamics and indigenous land claims. This is modern mining, high-tech, high-risk, high reward, and absolutely essential to modern civilization. The $216 billion worth of metal still underground at Grasberg represents future iPhones, future electric vehicles, future solar farms, future power grids. Without mines like Grasberg producing at massive scale, the energy transition stalls. That's the ultimate irony. Achieving a sustainable energy future requires massive-scale resource extraction that itself raises environmental and social challenges. There's no escaping this tension. We need copper for electrification, and Grasberg is one of the few assets that can deliver at the necessary scale. When operations resume at Grasberg, likely in phases through 2026 and 2027, the world will breathe a collective sigh of relief. Not because the mine's environmental or social challenges have been resolved, but because global markets desperately need the 680,000 tons of copper and 1.7 million ounces of gold it produces annually. For Indonesia, restarting Grasberg means restoring significant GDP contribution, tax revenue, employment, and export earnings. For Freeport, it means restoring 30% of copper production and 70% of gold production that drive the company's profitability. For the workers and their families, it means restoring livelihoods and economic opportunity in a remote region with few alternatives. For the 7 workers who died in the mudslide, there is no restart, only memory, and the hope that investigations lead to improvements preventing future tragedies. This is the human cost of resource extraction that economic data and production statistics can obscure. Behind every ton of copper and ounce of gold are real people working in dangerous conditions to extract the materials modern society demands. The story of Grasberg is ultimately a story about scale, value, and dependence. The scale of production is staggering. 240,000 tons processed daily, billions of pounds of copper, millions of ounces of gold. The value is extraordinary. Over $9 billion in annual revenue at recent production levels. Over $216 billion remaining in the ground. The dependence is global. Copper markets moving on news from one mine, entire industries affected by production disruptions, national economies tied to extraction from a single mountain. As we move into an increasingly electrified future, this dependence will only deepen. Copper demand is projected to double by 2050 to support net zero emissions goals. Yet, there are very few Grasbergs left to discover. The easy deposits have been found. Future discoveries will likely be deeper, lower grade, more remote, more technically challenging, and more expensive to develop. This makes existing world-class assets like Grasberg increasingly valuable over time. The $40 billion valuation placed on the deposit in 1988 has been realized many times over through production, and the remaining reserves could be worth even more if copper prices rise as forecast. If you found this deep dive into one of the world's most valuable mines fascinating, subscribe for more financial breakdowns of the operations that shape our world. Next time we'll explore the economics of the Oyu Tolgoi copper gold mine in Mongolia and why it became one of the most expensive mining projects ever developed. The numbers will surprise you.